the Mag 7, some of their free cash flow is actually starting to go negative. This is coming at the very same moment that AI and the data center build out is the one thing keeping GDP positive. If you remove that, your GDP is zero. You are racing in this kind of arms race, Meta versus Google, and they're all competing against one another to spend more money. Deranged levels of mania. How are you going to fund $750 billion of CapEx when your free cash flow is shrinking at 35% year over year? Well, the only way is to issue debt. And that's coming at the very moment that you have the $1.8, $1.9 trillion fiscal deficit, but eventually that comes due. There's no ability to roll it, to finance it, to pay it. And that would be kind of one thing if everything was okay when it came to energy. But the price of oil and this one conflict in the Middle East has second, third, and then fourth and fifth order effects that I don't think people have really thought through.
Infra, amazing having you back on the show. One thing we have to talk about today is the state of the markets and the fact that we are in one of the biggest bubbles possibly of all time. You labeled it deranged levels of mania. How is it that we are in the middle of a war, a giant oil shock, and yet markets keep ripping higher?
Deranged levels of mania. We have, sentiment, I would argue, at pretty extreme levels. You have this huge amount of CapEx coming from basically 5 companies. Now, that was what drove markets higher coming out of 2022. Same general idea. The hyperscalers, the Mag 7, they were spending a bunch of money on this AI, data center build out, and that was driving them to be kind of the safety trade. They had huge amount of free cash flow, and therefore, because rates were going up during this, 22, 23, because rates were going up, all that free cash flow was reinvested into T-bills, and they were making huge amounts of net interest income. There were these huge cash piles that they were earning net interest income on, and then they were using it to fund this data center build out and the kind of AI trade. That all, was kind of no big deal for me. And, from, 23 onward, I was pretty bullish on kind of the S&P and equities kind of broadly speaking, and GDP. I was bullish. Nothing about that model really bothered me. I didn't personally like the degree of concentration or the degree of valuation in some of the cases, but generally, I don't think it was anything to be concerned about. And I remained pretty bullish from 23 onward. Now, I would always say, I personally don't like the risk reward here, given the valuations, given the concentration. I personally don't like the risk reward, but, S&P 500 Qs probably going up and to the right. But what we've seen going back the past 4 quarters, that free cash flow, which was growing at, 50, 60, 70% year over year growth, in 23, 24, 25, that actually started to roll over in the past 18 months, maybe even 2 years, was kind of, I think, the peak of about 2 years ago. That started to roll over. And instead of free cash flow growing, now it's shrinking at negative 35% over the past 4 quarters. So how are you going to, that's coming at the very same moment when you are racing in this kind of arms race, Meta versus Google, and right, they're all competing against one another to spend more money. And if you look at the CapEx figure over the past, 3-4 years, it is basically doubling every year. And so we've gotten to a point now today in 2026 where we're talking about, $750 billion of CapEx. Now, that is a huge amount of money, right? Economic activity that is going to keep GDP somewhat supported. But when you look at where is it coming from? Where's all that CapEx actually coming from? It's not coming out of free cash flow, which was one thing, that you could make the argument totally reasonable, totally safe. Now, you want to make sure if you're an equity investor back then that they were getting a return, right? That they were monetizing and getting a return on that CapEx. But kind of from a systemic or macro viewpoint, it wasn't really concerning. But what we see now is $750 billion of CapEx while free cash flow is rolling over and actually going negative in some of individual cases with the Mag 7. Some of their free cash flow is actually starting to go negative. This is coming at the very same moment that AI and the data center build out is the one thing keeping GDP positive. If you remove that sort of investment and the data center build out and all of that, your GDP is 0%. The economy is not growing. So, it's coming at the very same moment. You have $750 billion of CapEx coming at the very moment that they can't fund it out of free cash flow. And that's coming at the very moment where this kind of build out, this sector, is the one thing keeping GDP positive. Well, that becomes a problem because if you can't fund it out of CapEx, if you can't fund the CapEx out of free cash flow, how are you going to fund it? How are you going to fund $750 billion of CapEx when your free cash flow is shrinking at 35% year over year, trailing 4 quarters? Well, the only way is to issue debt. And the issue there is the investment grade market already, according to Bloomberg, is going to be $2 trillion of issuance. This is coming at the very same moment where huge amounts, I can't remember the number off the top of my head, but if you look at that maturity profile of corporate debt, if you look at that maturity profile, huge amount is coming due to either most likely to be rolled over this year and next year. So you have $2 trillion of new issuance at the very moment that you have, at least, if memory serves, it was at least $500 billion that needed to be rolled over. And that's coming at the very moment that you have, called a $1.9 trillion fiscal deficit coming from the government. That's a lot of debt that needs to be purchased, right? We talk a lot about issuance of debt, whether it be a U.S. Treasury or whatever, just kind of forgetting, I think, sometimes that it has to be purchased. There has to be balance sheet capacity to absorb that debt. And that is really kind of where the problem comes, who is going to buy all of this debt? Who is going to fund not only the U.S. government, right, and $1.8 trillion, of new debt coming from the U.S. government, but 2.2, I just looked it up, 2.2 trillion of investment grade debt issuance. That's to say nothing of, the mortgage market. That's to say nothing of, junkier corners of corporate debt. That's, what I mean? You start playing this out. There's a lot of debt coming. And there's no balance sheet capacity to buy it. That is the real problem. So the main problem here being a huge amount of debt and a concentration of reliance, right? Whether it be economic or financial, if you look at the S&P 500, the kind of equity market issues. But even from an economic standpoint, we are relying entirely on this one sector. Huge amount of money needs to be spent, can't be spent out of free cash flow, has to come from debt. It's coming at the very moment, I just looked it up, $850 billion of investment grade corporate debt is maturing this year, and over $1 trillion is maturing next year. And then 1.3 trillion is maturing into 2028, and the fiscal deficit, you add in, again, junkier corporate debt issuance. That's a lot of debt. And that would be kind of one thing if, everything was okay when it came to energy. Yeah, but really, like, the reason this is so untenable, in my opinion, and so bearish, is that it's coming at the very moment that Europe and Asia, two current account, broadly developed Asia and Europe, those two blocks, call them, right, regions, generally run a current account surplus. By definition, what that means is they are providing credit to the rest of the world. And you look at who is a debtor, who is a creditor. The U.S. accounts for, call it 85% of the net debt in the world, just us. And then, emerging markets, call it 15, is some of the kind of smaller, emerging markets. Who provides the credit? Usually it's developed Asia, it's Europe, and then it's the GCC. Well, Europe and Asia are getting pushed. They are net importers of energy. So therefore, when the price of energy goes up, their current account surplus goes into a deficit. And we saw this with 2022. France, for example, Great Britain, I mean, they kind of already run twin deficits, current account deficits, but got pushed even further, right? So Europe and Asia, or developed Asia, are turning from a creditor, meaning they are buying our debt. They are buying our U.S. Treasury debt. They're buying our U.S. equities. They're buying our corporate debt, our corporate bonds. They go from a creditor to a debtor. When the price, they are net importers of energy, the price of energy is called doubled, and therefore their current account surplus shrinks and might even go into outright deficit. They turn from creditor to debtor. And then you look at the counter-cyclical kind of rescue, right? The GCC had been, in the whole kind of petrodollar system, had been a miracle where, we basically created a feedback loop, a system where, there was always going to be demand for energy. You look at the GCC, the Gulf Cooperation Council, Kuwait, Bahrain, Qatar, UAE, they're 50%, 60, 70% of their GDP, of their economy, comes from energy. All that energy is in dollars, denominated in dollars, petrodollar. And then so they're making, huge amounts of money. They run huge current account surplus, meaning they provide huge amounts of credit. On the other side of a current account surplus is credit, just double entry accounting. It's a accounting identity. They were counter-cyclical. The demand for energy might fall a little bit, but generally people were always going to need oil, nat gas, that sort of thing, right? So they were this kind of miracle where no matter what the economy was doing broadly, right? Europe and Asia kind of much more cyclical and at the whim of business cycle and kind of broader economic cycle within kind of the global aggregate. They were dependent on that, meaning, when things got tough, their current account surplus dipped into a less of a surplus or a deficit, which put pressure then, trickled into less buying of U.S. financial assets. That's how the whole kind of global economy is interlinked now. They were cyclical, and they were at the whim of these kind of business cycles. But the GCC was not. There was some amount of kind of cyclical increase or decrease in demand for energy, but broadly, everyone always kind of needed, a certain amount of energy, of oil, nat gas, that kind of thing. So what that meant, by definition, is that their current account surplus was kind of always there. It might go from 15 to 14% of GDP, which is enormous, by the way. But it was always there, meaning that they were always providing credit. They were always recycling those dollars into dollar-denominated assets like U.S. Treasuries. Well, not only are Europe and Asia getting pushed from current account surplus into deficit due to the price of energy doubling, but then you have the GCC, which was kind of that safety trait I'm spacing on, your trump card kind of, right? Where they were always there. There was always demand because they were always selling energy. They are turning into net debtors very quickly. We saw Saudi Arabia earlier today. It was announced that they were going to start selling, or they had already sold U.S. Treasuries. We know that UAE got into a severe liquidity issue within the past couple weeks, due to the fact that all those countries are pegged to the dollar, right? Which presents kind of a huge problem that's a bit separate, but it's all interlinked, meaning, the one price, the price of oil going up, has created a situation where Europe and Asia, developed Asia, normally, very healthy current account surplus. Therefore, they buy all of our financial assets, including our debt. They finance our debt. They are turning in a deficit. They cannot finance our debt. Their balance sheet capacity is going down globally. And then not only that, but the GCC, which was counter-cyclical, Strait of Hormuz is closed and their revenues are plummeting. You look at Saudi Arabian oil exports down 50%. I think it was in Kuwait down 90%. So who's going to buy all of this debt, whether it be the fiscal deficit, the 1.8 trillion of U.S. Treasury debt, whether it be, the 500 billion, 600 billion of hyperscaler debt, whether it be the 850, 900 billion of debt that is investment grade corporate debt needing to be rolled over this year, or the 1 trillion next year, right? So this one price, the price of oil, and this one conflict in the Middle East has second, third, and then fourth and fifth order effects that I don't think people have really thought through.
Not at all. We're just blowing bubble on top of bubble, right? We've got the U.S. national debt, $39 trillion. As you said, these hyperscalers are now getting into the debt game, and they are just blowing it until something happens, right? So you've called this the Ponzi finance stage, right? And it's all leading to a Minsky moment. But until then, we're sort of just the Wile E. Coyote over the cliff. We're running while we're over thin air. So explain to the audience, what is a Minsky moment and how soon are we to one?
Yeah, I will share my screen because I think I have a chart that is pretty good for this. So if we look here, if I can find it, I just had it pulled up. I think the best way to illustrate kind of the Ponzi finance stage that we are at is this chart here. So this shows the S&P 500 divided by the average hourly wage. And what this is indicating is the number of hours of work to buy one share, one unit of the S&P 500. So what this is also, that is kind of the easy way to process this information. But what it's really showing is the relative rate of change between two figures. It's showing you the relative rate of change of the S&P 500, which is kind of what I use as a proxy for the financial corner, right, of the American economy, relative to the real economy, which is what is the average American making in terms of their average hourly wage. And you're looking at the rate of change. Both of these are going up and to the right. If you look at the average hourly wage, it looks great. Everything is fine, right? The problem is you have to deflate it because we know inflation and debt growth and M2 money supply and that kind of thing. So what we're looking at here is the rate of change between the two figures. They are both going up and to the right. We know that with S&P 500 certainly, but it's showing you the relative rate of change. If the S&P 500 is increasing faster than the average hourly wage, this line is going to go up. And sure enough, this chart goes back to 1967. So what is that? 60 years basically of history that we're looking at here. What we can see is that during the period of time, kind of pre-globalization, pre-financialization, right, before we started running huge trade deficits and therefore huge capital and financial account deficits, right, of capital inflows into our financial sectors. Before that, the S&P 500 was growing, right? It was going up, but the average hourly wage was actually going up faster during this period of time. This was before we started running huge trade deficits, before we financialized the economy and started growing the debt faster than GDP. Was before all of that. And then what we can see is kind of in the 80s when we started to really embrace globalization and globalism kind of as a religion, and started to really financialize as a consequence of that, and as a consequence of the dollar's reserve currency status. As that all kind of, that ball kind of started, the snowball started to pick up, this just started to take off. And we went from, call it 20 to 30 I would say, from the 60s up until kind of the late 80s, it bounced between, call it 15 and 30. So 20, 25 hours of work to buy one share to now 230. And so this is, I think, the best way to illustrate how disconnected we have gotten the financial sector has gotten from the real economy, from the average American. And you mentioned Minsky. So the other thing that is kind of a hallmark that Minsky talked about was debt. And obviously, you mentioned the $39 trillion of debt that the US government is now in, and therefore the taxpayers are now in. And that's another hallmark that I would argue we are seeing more and more of. So here we're going to look at debt to GDP. And I want to point out something very interesting, which is that debt was growing. Obviously, the debt is always growing. I think most people by now understand this. But again, relative rate of change. When you're looking at debt to GDP, you're looking at debt divided by GDP. So if GDP is growing faster, if the economic output is growing faster than the debt is growing, they're both always growing pretty much. But if GDP is growing faster, this line will decline. And sure enough, that is what it did from the 60s, through the 70s and all the way into the 80s. So not only was the real economy, the average hourly wage growing faster. Money velocity was growing during this period of time. Personal income as a share of them to money supply. There's a number of metrics I could point to, but point being, the real economy, the average American was benefiting. That started to all reverse. And what started to happen? We started to fuel more and more debt. Debt started to grow faster than the overall economy. So therefore, debt to GDP, that metric goes up. And, during this period of time, debt to GDP had declined down to about just 31%. And obviously is 4x'd in the past 40 years. What that means is that debt has grown 4 times faster than GDP. Think about that for a second. It is one thing. I'm not anti-debt. If you can go into debt to go be a doctor, right? You go into 200K of student loan debt. It's probably more, but 200K of student loan debt to go be a doctor. But as soon as you graduate, you're going to be making $500,000 a year. Then that debt is productive, and it's a good decision. It is the smart thing to do, is to go into debt. However, what we are seeing is the exact opposite, which is that since 2008, each new dollar of debt has only returned about 55 cents of return, meaning we are getting a negative return for each new dollar of debt that we are going into. We are, and the same is true, by the way, if you look at M2 divided by GDP, it is the same figure, unfortunately, which is that M2 is growing far faster than GDP. We are printing for prosperity and not getting as much prosperity. We are not getting as much economic output as we used to. And so this is a major problem, obviously, for kind of because it's unsustainable, right? You can't just print money. You can't just continue to print money, get less and less actual economic output, which is, here proxied by GDP. GDP, as we were talking about before, kind of has its own issues, right? When one sector, one tiny little sector is keeping GDP afloat single-handedly. GDP itself is kind of a flawed measure, but it's kind of the best we have here. Again, the money supply was growing, but it was growing slower than the economic output of the U.S. economy. That trend continued a little bit further on than debt to GDP or my financialization metric. But generally, right, we were getting healthy economic growth here. The real American was outpacing the kind of financial assets and the S&P 500. Their wage was growing faster. Money velocity was kind of trending up, meaning the real economy of money changing hands, that was going up. Debt was growing, but it was growing less quickly than the overall economy. It was a period of actual real growth. And what we have seen since then is M2, which is green here, M2 divided by GDP. we have just the M2 money supply has gone from here in 1997, 46% of GDP to now 71%. Of course, it was much higher before we destroyed a bunch of money in the QT of 2022. But nevertheless, that is basically a doubling, meaning the M2 money supply has grown twice as fast as GDP. Debt, if we go back to call it the 1980s, the debt has grown 4 times faster than GDP. So we are printing for prosperity, and included in that is printing debt, right? Issuing more and more debt to try to get ever less economic output. And that's just not sustainable. Eventually, it will kind of all come due, and there will be no ability to roll it without. I'm not in the camp that everything blows up spectacularly, but I do think that the Fed will have to come in, print the money, bail it out. I don't think they're just going to let the entire U.S. economy and financial system blow up. But that is kind of that Minsky moment where, the debt, we have tried to defy financial gravity for decades, and we were somewhat successful, but eventually that comes due. And, there's no ability to roll it, to finance it, to pay it, certainly. So what do? We print the money. And
thanks for making it to the end of the video. If you could drop a like and a share, it would help in our mission to accelerate adoption. If you're looking for more Bitcoin signal, join over 10,000 readers of our newsletter, Bitcoin News Weekly. Every Monday morning, we send out the biggest headlines of Bitcoin to keep you in the know in under 5 minutes. Links below in the description. Then come hang with us live every Monday at 11 a.m. Eastern. We break it all down live on stream with a new guest, and you can add your 2 sats in the chat. See you next week.